Hi, this is Vijay Pambani. I hope you're enjoying your trades in the market and you're noticing how the volatility is stepping up as we approach the budget. This is something that I have been talking about and writing about on my Equity Masters Telegram channel, which if you haven't already joined, you must join with the handle Equity Master Official, wherein I put up end of the day updates based on statistical data that's available from the exchanges, which help you take informed decisions. Now friends, in this video, I want to touch upon a topic that has been a burning question with some of my viewers who've asked me either via comments or connected with me on social media, on my social media pages, and asked me as to whether a trader, now please understand we are talking about trading and not investing. So you need to keep that in mind before you fire off any comments. So whether a trader is better off trading the indices, which is the Nifty or the Bank Nifty, or trading individual stocks. Now this is no easy answer. So I'm going to take a 360-degree approach and take a rational view from the point of view of statistical data available to us and take a rounded, informed decision as to what suits you. You see, the indices are nothing but comprised of those constituent stocks. So the BSE 30, as the name suggests, is an index of 30 stocks with various weightages, and as the stock prices move, so does the index. The Nifty 50 is a much more broader index. It comprises of 50 stocks. The Bank Nifty comprises of 12 stocks, two of which whose weightage is so small that they are insignificant. So in a practical sense of the word, the Bank Nifty is actually an index of 10 stocks. Now, the way the indices are compiled in India, they use the free float method, which means the number of shares which are available free float and the MWPL or the market wide position limits allowed by the Securities and Exchange Board of India is a percentage of the free float number of shares. Now I've recorded various videos on the market wide position limits and how to check out the open interest data and take informed decisions accordingly. You can scroll down in this playlist and check out those videos for yourself. But for now, we are going to focus on the topic whether an index or an individual stock is better for trade. Now, because the indices are comprised and compiled on the free float method, what really happens is that stocks which are constituents of the index, if the price goes up, their weightage also tends to go up. And if the price falls, their weightage tends to fall. So what really happens is that the skew or the bias is towards the upside. The idea is if the stocks are falling, let their weightage fall so the index falls less. And when the prices are rising, the weightage rises, therefore the index gains momentum on the upside. Now, I'm not here to argue whether this is fair, unfair, right, wrong, whatever, but this is the way the indices move, which is why in my videos, whenever I've recorded videos and tried to project when a correction will come in. Remember, I'm talking of a correction, not a reversal. The markets don't seem to be appearing to head for a reversal just as yet, as I record this video on Monday, the 4th of January 2021. So all we are talking about is corrections, and that too I frequently use the word probability and not certainty. It evokes a lot of amusing comments from skeptical viewers who say, why can't you use the word certainty and why probability? Now you see in this video, when you see what's happening, you will realize why I use the word probability. Now take for example the most heavy weighted counters in the Nifty 50. I'm talking about the top 5 or 6 weighted counters. In July, Reliance was still rising and it was weighted at 14% weightage. In December, Reliance is going sideways and is under pressure. It's way off the recent highs and the weightage is now 10.66%. HDFC Bank in July was 9.56%. In December, it is 10.37%. Infosys was 7.56% in July. In December, it is 7.64%. HDFC Limited was 6.59%. It's now 7.61%. TCS, which was 5.12% in July, is now 4.99% in December. Now, what really happens is that the index weightages are therefore telescopic. You know, in the olden days, you used to have transistor radios which had antennas which could be pulled out and collapsed right in. Those are called telescopic antennas. They can be elongated and compressed just like your telescope used to fold in. So the indexes, or the indices rather, are telescopically weighted. Therefore, the probability of the index rising is far more than an individual stock. If you're looking at trading based purely without this weightage factor pulling and pushing on a security, because an individual stock will either go up or go down. An index, on the other hand, will go where the top 5 or top 6 weighted counters, which comprise more than 50% of the weightage, will go. If you think the Bank Nifty is doing any better, let me just run you through a couple of numbers and you'll see where I'm getting at. Let's now take the top 5 weighted banks in the Bank Nifty space. Axis Bank in December is 15.35%. In September, it was weighted at 14.36. In June, it was 14.58. HDFC Bank is now weighted at 26.08. In September, it was 28.83. And June, it was 27.70. No surprises there because HDFC Bank of late has been plateauing. ICICI Bank in December is 20.05, in September 19.61 and June 18.66. Similarly, Kotak in December is 15.88, September 14.89 and June 16.33. State Bank of India, the largest bank in India by deposits and loan book, etc., is 10.54% in December, 10.44% in September, and 10.87% in June. So as you can see, the weightage is not really static, it is dynamic. And who basically gains the most out of the Nifty rising? It is the ETFs, the exchange traded funds, which invest in the index. Now, this is another request that I have received from my viewers of my videos in the Fast Profits Daily. Why don't you make a video on ETFs? Just as we've made ETF videos on gold, why don't you make ETFs videos on Nifty and Bank Nifty ETFs? Hey, your request is under consideration. I've forwarded your request to the editorial team. Hopefully, we should be doing a video on this soon. So it is the index ETFs which happen to gain a lot from keeping the index rising, and therefore the net asset value of the ETF going higher progressively. Before you start to worry or wonder as to why this is happening, let me run you through how much money the ETFs are handling. Remember my video about Napoleon taking generals to war. He took those generals with him for crusades to conquer other nations who were known to be plunderers and corrupt, who pocketed a lot of wealth on the side. But Napoleon said, as long as they know they are going to enrich themselves, they are going to fight harder for me and ensure that I win over many nations. So vested interest in financial markets is the biggest thing that drives the markets up or down. 5 years ago, the Nifty and the Bank Nifty ETFs handled 7,000 crores as assets under management, or AUM. Today, the ETFs are handling more than 2 lakh crores. That's right, 2 lakh crores from 7,000 crores. That's like a many-fold rise, and of which more than 1 lakh crore is in the asset under management in the Nifty ETF. Bank Nifty ETFs handle approximately 40 to 50,000 crores. Now, who are the biggest holders of these ETFs? I beg your pardon. 92% of the corpus of this 1 lakh crore in the Nifty ETFs is held by the EPFO, or the Employee Provident Fund Organization, which handles the provident fund of central and state government employees and also private citizens, but mostly it is the central and state government employees. Then you have pension funds, private and public sector, and some institutional holding. Merely 8% of these ETFs are held by retail investors. So you see, it is big money which is invested in the Nifty ETF, which tells you why the markets are on a tear, why the markets refuse to correct, irrespective of many estimates being put out. Oh, the Nifty will correct from XYZ level, or the Nifty will correct from ABC level. The ETFs and therefore the indexes are so skewed in favor of going up all the time because of their telescopic weightage, that you will never really get a true picture of what's happening. So if you're a trader who wants to trade in a instrument which happens to go up and down both, stick to individual stocks rather than the indices. However, there are some system-based traders who believe in delta neutral strategies, going long on something and going short on something else, so that the exposure is balanced and therefore there is not too much of a damage to the net profit and loss account. If you're looking out for delta neutral strategies, maybe the index offers you ample amount of cushion and comfort, because that would be the place where you can hide in a cave during times of adversity. I hope this video clarifies a lot of doubts that you have as to why the markets are not correcting and whether you should be trading the indices or individual stocks. There's big money at play here, so you need to know where you are vis-a-vis the broader markets. Who are you fighting against? Who are you fighting with? On this note, I'll bid goodbye to you in this video, not before reminding you I'll be back in my next. If you like this video, you're watching it on YouTube, click like on this video, subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive alerts about fresh videos being uploaded here. In the comment section, do let me know what you think of this video and what you would want me to record in my next. Help me reach out to fellow like-minded traders who are looking out for knowledge-based investments and trades by recommending my video to your family and friends. Have a very, very profitable day ahead. Take good care of your health, your family, your friends, investments and trades. Vijay Bambani is signing off for now. Thank you for watching. Bye-bye. So, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.